We're going to go through the relative valuation from today. Okay? Multiples. Chapters 17, 18, 19, and 20 are the ones you have to study. Right? So before we start, try to answer this question. Which of the following makes no sense? First is valuing Samsung Electronics with DCF. The other is valuing your apartment with DCF. The second one, right? I mean, if you try to value your apartment by trying to expect how much cash flow you can generate with your toilet bowl or bedroom windows, does not make any sense. Okay? Just look at your neighboring unit's apartment, similar sized, how much is it priced, and that must be your apartment's price. Same idea here. If you want to value your company, try to find out some identical twins of your company. If those identical twins are priced as such, that should be your company's price. But the trouble is that there's no identical twin in your company. Okay? All different companies are different. Okay? But we're trying to assume some companies are similar. In one respect, it could be same industry. It could be same industry. It could be in a different industry, but similar risk characteristics, similar beta, or growth potential, expected growth rate is similar. All those economic fundamentals, if they are similar, then their price has to be similarly done. Okay, that's the idea. We are just assuming that the asset is efficiently priced on average. When we use relative valuation, that's the second point we want to make. There's an abuse of language, okay, in the industry. Valuation, and then they say intrinsic value. Okay, the word intrinsic value, that's uniquely for DCF value number. The value justified by your fundamentals, economic fundamentals. What do you mean fundamentals? We have two channels, as I said. One is what? Risk, and the other is cash flow. Come on. Okay? Two channels of your value. Risk and cash flow. Nothing more. Finance is simple world, right? Risk and cash flow. Those fundamentals. And then if you do the DCF and then get the value, that's the intrinsic value, what we call 내재 가치 in terms of Korean language, right? But people in the industry abuse this word intrinsic value and then use this language even when they try to use relative valuation. Based on PE multiple, your intrinsic value has to be something something. That is not really intrinsic value, but they use it. Okay, so don't get confused. Now, the essence of relative valuation. In relative valuation, the objective is to value assets based on how similar assets are currently priced in the market. Okay? To do relative valuation, then what you have to do is identify comparable companies or comparable assets, right? Where are those peers, and then see if they are how they are priced, and all average price of them should be the efficient price, and my company's price should be like that. The trouble is, you cannot just find an easy price or value, okay, of your stock to fairly compare with the other stock. For example, Berkshire Hathaway's stock price is around $1 million or $1.5 million sometimes, right, or $2 million per share. Per share basis, $2 million. Can you imagine that? Now, can you compare price to price, okay, basis with Google or Apple, which is typically priced at $300 or $500 level? No, okay? We have to standardize it somehow. Different prices. The reason for having different prices is because different numbers of shares outstanding in the first place. Okay, it's the manager's choice. What's the number of shares outstanding you wanna have? Okay, that's the CEO's choice. So how can we standardize it? Divide your price by some common fundamental numbers. For example, earnings per share. Okay, earnings per share, that's also per share basis. So price per share is per share basis. So per share basis divided by per share basis. So the number of shares, the division cancels each other out. So for each earnings number, how much are we willing to pay? Okay, that's the idea of PE multiples. And in that basis, we can compare Berkshire Hathaway and Google or Tesla. Okay, so that's the idea of converting these market values into standardized value. Okay, so that's that. But once we standardize it, we don't stop there. Okay, we don't stop there because there are some economic fundamentals that drive this multiple somehow. Okay, so we have to control for those economic fundamentals, and then any differences between the firms that might affect the multiple. Now, relative valuation. Okay, how common is it? Well, as it turns out, almost all of your valuation in your industry would be relative valuation. Okay? You seem to be happy today. Relative valuation is quite common. Okay? And then DCF, pure DCF valuation is not that much used. Okay? By that, you may feel betrayed somehow. Okay? Why the heck did you spend almost 85% of the semester studying the DCF and then only 15% of your time is allocated to the relative valuation? The answer is this. After all, your bosses and your industry competitors, and your analysts, right? They want you to analyze your relative valuation numbers using DCF idea. What we call the analysis process in what we're going to do today. Okay, wait for that one. In the end, they want you to be able to discuss PE multiples, how come it is high or low, by talking something about growth rate of cash flows or risk of your company. Those risks, we're talking about beta. Okay? We're talking about the leverage ratio, financial risk, operational risk, all those things. You want to connect these things to your multiple that you use today. Okay? So you need to have firm understanding, solid understanding of DCF to be able to work with multiples. Okay? That's why we allocate most of the time for DCF first. And relative valuation is kind of something you come up with all the time. Different people come up with different multiples all the time, right? Sometimes they make their names, like Peter Lynch, okay, with his own multiples, and then earn a lot of money. Sometimes you're misled by those new multiples, so you have to be critically understanding those new multiples with DCF understanding. Okay, we're gonna get there. Relative valuation, quite popular. By the way, why is it popular? It's easy to deliver. Okay, you can think about doing your stock recommendation to fund managers in Korea Investment Corporation, and then call up the fund manager and say, let's say, Mr. Fund Manager, here is a wonderful company called Amore Pacific. I want you to buy this because their beta is somewhat, and then the leverage ratio is somewhat, the weighted average cost of capital is somewhat, and the free cash flow to firm, blah, blah, blah. By the time you reach the beta, the guy will hang up the phone saying, I'm busy. Okay? That's the shortcoming of DCF. It takes a long time to convince them. Relative valuation, it's easy. I want you to buy this Samurai Pacific. Industry average PE ratio is 30 times, but this guy is in trade at 20 times. Buy it. 15 seconds, right? So easy to convince them, quick. So that's why it is more popular, okay? And acquisition valuations, you need a lot more explicit DCF valuation, but still 50% of them almost, right, are done in relative valuation sense, right? And then rule of thumb based multiples are not only common, but are often the basis for final valuation judgments. Sometimes people talk about M&A in terms of EV to EBITDA ratio. How much did the company pay? Like for example, when Down Kakao bought Melon, and then what was the EBITDA multiples, right? Was it 6 times or 5 times? Did they overpay or underpay? They base their judgments on this relative valuation number. While there are more discounted cash flow valuations in consultants and corporate finance world, because they have more insider information, okay? What's your leverage, or what's your future debt repayment schedule? If you have those, you can do the precise DCF valuation. That's why consultants and the CFOs can do it, okay? There are some still relative valuations mixed together with it. For example, when you're working out the terminal value calculation using PE multiples or EV to EBITDA multiples, essentially 90% of your DCF is done by relative valuation. Okay? Sometimes, likewise, people mix it. Okay? And then, so consider the importance of relative valuation in that respect. Now, here's a conceptual diagram that I drew, okay? Here, what you see on your horizontal axis is time, as time passes, right? And on your vertical axis, there's PE multiples, right? Which is price per share divided by earnings per share, okay? And then at one given time, you can think about your competitor firms, and as well as your company, would be dotted like this, okay? Some companies will have high PE ratio, some companies will have low PE ratio, but on average, they will be clustered around this average, or I should have said median, okay? I will talk to you about why median, but they will be clustered around here. And our critical assumption in relative valuation is that market is efficient. Yes, market is efficient on average. So if you look at the average PE ratio or median PE ratio, this should be fairly priced or efficient level of PE ratio. That's what we argue. Okay. I never knew the microphone had this sponge. Right. At one point, it just reminds me of my baby, the firstborn baby, my daughter. All of a sudden, when she was 1 year old, right before I was supposed to go to a neighborhood's party with my wife, she ate this thing, swallowed this thing, and then we were like, ah! And we just cannot, we were afraid this would choke her or something, and then we canceled our plan to go to the party, unfortunately, but luckily, came out as a poop, no problem. Once you get married and give birth to a child, you should be careful because they swallow everything, anything, okay? But sometimes it's okay. Sometimes that one, sponge, no problem. Anyway, so that's that. Where were we? Right. On average, it will be fairly priced, efficiently priced. Some small number of companies may deviate a lot. That gives us the investment opportunity, right? That's the idea. So maybe you will find some significantly undervalued companies. Buy it. Maybe you will find significantly overvalued companies. Short sell it. That's the idea, okay? And then within short period of time, it will converge to efficient level, like this. What's the time horizon? Maybe 1 month or 2 months, we don't know. But usually shorter investment horizon. So relative valuation works better for hedge funds or short-term investors, whereas DCF valuation is better for Warren Buffett kind of long-term investors or private equity managers, right? Now, that was when the market was doing all right, but sometimes the market will be booming, okay? Maybe your economy, the whole economy is doing well, and then average PE ratio may go up together, right? Even in that case, you will find some companies overvalued or some companies undervalued relative to this median at that stage. So it's this is what people call market neutral, because every situation, whether the market is in boom or bust or not, okay, we assume the market is efficient. We don't say the whole market is in bubble, okay? We don't say the market is in bubble when you use relative valuation. That's an interesting part. And hedge fund managers say we use market neutral strategy. No matter where the market is, there are some stocks we short sell and buy or long, okay? And we still make money because they will converge to industry average somehow. So that's the idea. Okay, market is efficient on average, and then what are those most popular multiples people use? By far, PE ratio. Okay, PE ratio, long history. Okay, has been there for a long time, and then these days, increasingly, they are using EV to EBITDA multiples, and then some other multiples like price to book ratio. And here are some other valuation tools like residual income model or DCF model. Essentially, residual income is one part of DCF, and FCF is also free cash flow method, right? Not too much of a concern. The residual valuation is something equivalent to economic value added concept, okay? Just focused on equity side of it, okay? But we're not going to test you about it. As long as you know about DCF, that's just fine for our semester. Now, multiples, right? Relative valuation. What kind of multiples are we going to learn, okay? What kind of multiples are we going to learn? We can group the multiples into largely 3 different categories, okay? Depending on what kind of variables are used as denominator. I told you before, the multiple typically has some price, market price, related value in your numerator, okay? Whereas it has to do with market value. It could be called either price or some value, okay? Does not matter. Something that you observe in the market, typically. Then we standardize or divide this guy by some accounting-related variables, okay? Accounting-related variables. What kind of variable do we use determines the group of multiple that we categorize. It could be earnings related variables, which is net income or operating income or EBITDA kind of things. Another kind is book value based multiples. Book value numbers, for example, assets or some book value of equity, yeah, over there, or replacement cost. The third category is revenue based, okay, multiples, which is sales, right? So one of them is coming from balance sheet, the other two coming from income statement or accounting related numbers. Okay, some book value based numbers as a standardizer or denominator. Okay, so for a given dollar of book value based number, how much are the investors willing to pay? Okay, in the market. That's the idea of relative valuation. So 3 categories: earnings-based multiples, book value-based multiples, and revenue-based multiples. We're going to learn about it one by one. And then earnings-based multiples, we have PE ratio and PEG ratio. And then we will learn value to EBITDA ratio. Okay? And then book value based multiples, we're going to learn about price to book ratio. And then revenue based multiples, we're going to learn about price to sales ratio and value to sales ratio. And you'll find out in your experience in the industry, you'll find out there are a lot of new multiples people invent. Okay? People invent, and you have to, try to be critical in those new multiples and see if those multiples make sense. Okay? Now, anytime we study multiple, we're going to use 4-step procedure. 4-step procedure. You can almost memorize this one, right? Define, describe, analyze, and apply. DDAA, right? Define, describe, analyze, and apply. What do you mean by that? Well, define. Well, to work with a new multiple, you need to define it first. How is it constructed? Okay? Define it clearly and consistently and uniformly to be able to make a fair comparison. Okay? That's the definition stage. Once we define, we will move on to describing stage. What do you mean describing? Well, we want to go to the data and see how it is distributed. Typically, it will be positively skewed. A lot of extreme variables up there, okay? Because sometimes market price will have some extreme high value, whereas your book value numbers may converge to 0 sometimes, okay? In that case, your multiple will explode. So your distribution will be highly skewed, and it convinces you to work with a median instead of average. And the third step, okay? Third step is analyzing, okay? Analysis, 분석하기. This is kind of mathematical word, okay? The whole purpose over here is to identify the relation between the multiple that you work with and the economic variable, the fundamental variable, the mathematical relation. You find it. It could be positive relation or negative relation. You identify those relations through this process. Okay? Analysis, in our translation in Korean language is kind of misleading. If you go to math department in any US schools, right, you will find some course name titled Real Analysis. Real Analysis. At first sight, I was thinking like, oh, this must be seriously analyzing some phenomena in real sense. Sounds good. But no. Analysis in mathematics is just proving stuff, okay? Proving the theories or any mathematical relation. For example, y is real numbers, uncountable and infinite, whereas the rational number is countable and infinite. That kind of things. And how you define those integration and the differentiation, all those crazy math is about analysis. And we are going to do that over here. Okay, I'm not going to ask you to prove why is this countable or not, that's crazy. But we're going to learn about how PE ratio is driven by risk variable, and how it is driven by payout ratio, how it is driven by the growth prospect. Okay, mathematical relation, you will find it. That's the analysis process. Once we identify those relations using this mathematical analysis, we move on to the final stage, which is applying it. Apply it to what? Apply it to your data. Okay, it's gonna be essentially regression. Okay, run a regression using your PE ratios of thousands of different companies and the key drivers of these multiples, which is growth rate or payout ratio or risk variable. Okay, you will be able to generate XY plot, okay, XY scatter plot, and run regression and check and make sure those relations really hold in your data. Okay, if you find it holding and the relation is consistent with what you find in this third step, then you can use it for your investment valuation. Okay, and determine finally whether your stock is fairly valued or undervalued or overvalued. Okay, in that regression chart you can find it. So we have 4 steps: define, describe, analyze, and apply. Okay. Each and every time we come up with multiple. So, first step, definition. Okay, what do we have to worry about? Well, when you define a multiple, you have to be consistent. What do you mean consistent? Your numerator and denominator has to be about the same kind of claim holders, same kind of investors. Yeah. What do you mean, same kind of investors? If you look at the balance sheet, okay, claim holders, we have debt holders and equity holders, right? And then here's the asset, let's say, okay? Now, if your numerator is about equity holders, make sure your denominator is also about equity holders. Okay? Sometimes your numerators may be about both debt holders and equity holders, which is asset, right? If that is the case, you want to make sure this guy is also about debt holders and equity holders to be just consistent to different kinds of investors. Okay? Some multiples are not consistently defined. Some are consistently defined. Okay? You want to make a judgment about which one to go. Right. So, for example, price to earnings ratio. When we say price, okay, price to earnings ratio. When we say price, it's typically equity, market value of equity. Okay, so this guy. You look at the share price in the market, okay, that's common equity. And then how about this EPS? That's net income divided by number of shares outstanding, right? EPS. That EPS is about this guy, equity holders. So both numerator and denominator is about the same equity holders. So it is consistently defined. Make sense? Right? And that's why PE ratio is widely used. Okay? Per, people say Korean per. Per, alright, fine. Per, right? Per. PE ratio. Americans call it PE, right? And then, how about price to sales ratio? Price to sales ratio. Is it consistently defined or inconsistently defined? Tell me somebody.
This inconsistent
Why?
because sales belong to both debt holders and
Right, did I say it over here? divided by firm's earnings. Right. It is inconsistently defined, right? It is inconsistently defined because price is about the equity, but the sales is about both debt holders and equity holders, right? Once you sell any asset, and then you have to worry about the interest payment, right? Those things are already in the sales, as well as net income that goes to your equity holders. Now, so some of the multiples are not consistently defined. And then uniformity is another thing you have to worry about. What do you mean? Well, when you construct the variables, right, PE multiples, EPS, for example, over here, do you mean last year's EPS, or trailing 12 months EPS, or next year's expected EPS? It could be anything, but stay with one thing. Stick to one thing and apply it uniformly. Okay? Don't build your PE ratio using last year's EPS for your company, but expected PE ratio for the rest of the company. No way. Okay? Uniformly just apply the same definition. That's the thing. Okay? And then variables used in defining the multiple should be estimated uniformly across all assets in comparable list. Now, PE ratio is our first item we're going to study. Okay? Right. Hello. Right. Okay. This is price per share divided by earnings per share, and gives you the idea about how much are investors willing to pay in the market for a given dollar of net income per share. Okay? There are a number of variants in PE ratios. They are based upon the price and the earnings are defined. And the price could be either current price or over, average price over the past 6 months or a year, right? But typically current price is just fine. EPS, okay, I told you before, should it be current EPS, which means last year's most recent fiscal year's EPS, or should it be trailing 12 months EPS? As long as you have quarterly reports, you can compute this guy. But once you do it, do the same thing for the other thousands of your companies, right? And then forward EPS, you may have some analyst expectation about next year's EPS figure.